Take two on learning objective number 3 is to close the revenue and expense and dividend accounts. You just missed some brilliant lecturing by me, but I messed up closing the file and I lost it. So let's do it again. Closing the accounts. This occurs at the end of the period. What we're doing is getting the accounts ready for the next period. Okay? We want to zero out the revenue and expense accounts. Why? Because we want to measure the revenues and expense for each period. Okay? Why are we closing these out? Because these are the temporary accounts. We close them out at the end of the period. We want to zero out the revenues. We want to zero out the expenses because we measure them from period to period. We also want to zero out the owner's withdrawals because we want to measure what the owner is withdrawing every period. Remember, they're not taking a salary. Owners aren't allowed to get a salary. They get a withdrawal. So what this is going to do is zero out the revenues and expenses and withdrawals and start the next period with a zero balance. So those three types of accounts would be temporary accounts. On the other side of the coin, we've got the permanent accounts. The permanent accounts are not closed. The permanent accounts are the assets, the liabilities, and the owner's capital balance. Remember from our worksheet that these appeared on the balance sheet, part of the accounting equation. The ending balance from the balance sheet we just made up at the end of May the 31st, becomes June 1st's beginning balance. So, what we do is, for the closing entries, is we transfer the temporary accounts, revenue and expense, to capital. We do this by using an intermediate account called income summary. It's only used in the closing process, and what it does, it summarizes the net income. How does it do that? Summarizes the net income. We close the revenues to income summary. We close the expenses to income summary. It's a temporary holding account. Okay? And whatever we need to close that income summary gets closed to capital. Okay, so closing entries really come in four forms. Closing entries, there's really four involved. Okay, so that's the revenue entry, the expense entry, the income summary, closing entry, and of course the entry to close the owner's withdrawal. So, for the recording closing entries, the process is to close out, number one, your revenue account. From the income statement, we knew that service revenue was $6,500. So if we come over to our journal, what we're going to do is post on 05/31/10. What we're going to do is we're going to debit our service revenue account. Okay, service revenue was $6,500, debit, and what we're going to do is we're going to credit our income summary. Okay, and the explanation to close revenue for May 2010. Our second entry is to then close the expenses to the income summary account. Now, the normal balance in an expense account is a debit, so what we need to do is we need to credit all of the expenses. So therefore, we would debit our income summary account. Okay, so our total expenses equal $2,900, so that will be our debit to income summary. Okay, let's just fix this up here. It's bothering me. Okay, see, I want this to be to the left. Okay, so we have our debit to income summary of $2,900. Next, what we're going to do is we're going to credit all of the expenses. We have salaries, depreciation, supplies, and utilities. Okay, so we're going to credit salaries expense, $1,000. We're going to credit the depreciation expense for $1,000. Okay. So we've got our salaries expense, we've got our depreciation for $1,000. Next, what did we have? We had supplies and utilities. So we're going to debit the supplies expense $500, and we're going to credit the utilities expense $500. Okay, so a little formatting here. Paste. You need to see two utilities. And we said that was $400. Okay, so let's just check on that. Supply, salary, depreciation, supplies, utilities. Salary, depreciation, supplies, utilities is correct. And we'll say we're going to close our close our expenses